Hey, I want to welcome everybody to the webinar tonight, Profiting from Bearish Chart Patterns. Actually, we probably should be looking at some long chart patterns right now, but no matter how bullish it might look at the moment, there will be someday we'll look at some bearish patterns. So you kind of have to know them both up and you have to know them down as well. Alrighty, let's see. Quick mic check. Just make sure that we have a mic. Everybody should have the camera up, my chart. Actually, what you're seeing there is my chart that I use in the trading room, or I should say my screen that I use in the trading room. Yes, that chart. So you're kind of seeing everything goes on the trading room. A quick mic check so far. I may be talking to myself here. Anybody? Oh, there we go. Okay. One person is good. I'm good with that. So, hey, I've got a couple of questions I'd like to ask. First of all, does anybody here not short? Does anyone here not short? Not yet, Peter, not yet. And you know, there's nothing wrong with that. There is ways to trade the market, and it can be tanking, you can still trade short. You just use inverse ETFs. That's something I like to do a lot. In fact, I have a couple of inverse ETFs that I always have standby. If the market starts to drop, then I could just go right to them and bang. I don't have to look at them. I don't have to do anything. They're just right there. Like TZA. TZA is probably my first go-to, simply just shorting IWM, shorting the Russell, TZA, SPXU for the SPY. Those are a couple of my go-tos. I love using the fear indicators. Let's see here. I'm at a complete loss now. Not the VIX. I'll think about it in a minute. It's been a long day. It's been a very long day. Now it's got me bugged here. Let's see. I've got an interesting question here. What do I think about the UVXY? Thanks, Rollo. Appreciate it. UVXY. TVIX, those. Appreciate that. Interesting question. What do I think of the BR exit, the Brits exit vote and everything? And I'll tell you, really, I don't care. All right. Look, there is no way in the world I'm going to know, or anybody is going to know, what the fallout of this is going to be. It doesn't matter what the vote is. Nobody knows what the fallout is really going to be like. This is new territory. This is some new stuff. So I really don't know. And I'm simply just following the charts. And in fact, I could not even listen to the news tomorrow, and it wouldn't make any difference whatsoever as far as the exit goes, for me anyway. And that is, there's proof. There's proof to that if you just look at the SPY, and if you take off today. Now, today was an extraordinary day. In fact, let's go to a monthly chart. If you look at the monthly chart, if everything was going to be good, the big boys would have taken us up. If it was going to be bad, they would have taken us down. So what does that tell you? It tells you some of the biggest players in the world don't even know what's going on and what's going to happen. And seeing how we are swing traders, I want to put a little emphasis on that. Seeing how we are swing traders, because if you are not a swing trader, you might not be at the right webinar. And if you're a day trader, there's not much I'm going to do here that's going to help you. You're not much insight you're going to see from day trading. Long-term trading, dangerous game to be playing. So if you're a swing trader, I think you're on target, which means You can be in and out of stocks or in and out of cash in a snap of a finger. And what happens to market, overall market, really doesn't matter. It really doesn't matter. You just have to recognize those patterns. And yeah, you just have to recognize those patterns. So let's see. Richard uses the inverse ETFs. Okay, great. Market getting you down. Profit from bearish patterns. There you go. I like that, Mike. I like that. I might have to use that for a title one day. That's pretty good. Okay, we've got about 50 people in here. I've killed a few minutes, letting a few more people get in the room. So let's get going here. What I'd like to do is we're going to look at some charts. I'm not a big person on PowerPoints because, quite honest, they're boring, and a guy like me, I end up reading them, and that's just uncool. So I would like just to look at some charts, and we're going to talk about some bearish patterns. And the best way to learn is repetition and training your eyes. We have a series, and we're developing even more of train your eyes. I'll say education. Some are products, some are absolutely free. It's something we do all the time, and we really believe that education is the way to go, and to always be working and teaching your mind and teaching your eyes to recognize chart patterns. So that's what we're going to look at. We're going to look at some charts. I've already picked out some, and if we have time today, I'd certainly like to look at a few of yours that you may have in mind. I would like to keep this towards shorts because that is the title of today is shorting and profiting from bearish patterns. So I would like to keep it to that. It's one thing I would ask for this afternoon here. So let's see, on dust, inverse gold monitors. Why, with the lengthy drops in gold lately, why isn't it showing up on the price of dust? Sometimes, Richard, some of these ETFs, they can really kind of hold their own and just sort of explode. That can happen. Now, because I look at dust, and really it looks like it's setting up for a move up. It just hasn't moved yet. And if you take a look at Nugget, and Nugget is usually the one that I look at to go against, it's doing the opposite, and it really hasn't fallen too much at all. So what that's telling me is right now, the overall market, the overall world, in fact, is waiting to find out what happens. So there's so many charts. They're just in this holding pattern that they could possibly tomorrow, this market could explode one way or the other. Nobody really knows. Nobody really knows. And if the close today, if all the buyers in the close today were right, they're going to make a ton of money tomorrow. Because we had a lot of buying going into the close today. And if they're right, they're going to make buckets of money tomorrow. Personally, I'm a little bit frightful. I don't need to make all that money in one day. My job is trading, so I can sit back and relax. Today we made a ton of money in one stock today, the whole, trading room and all the members. So we don't have to go after this kind of risk. So, and what Sharon says is true. They're not always, the miners and gold are not always stepping together, not always at all. All right, so let's look at a few charts, and the first chart I want to look at is the chart that's staring us right in the face. And here's something too. I really have to talk about this just a little bit. If you have a bearish chart pattern, and let's just go with a head and shoulders, because that's probably one of the most well-known bearish chart patterns there is. And if you look, and if you see that, what does that mean? Well, it'd be easier to explain what it doesn't mean. It doesn't mean that guaranteed we're going to fall off a cliff. It's not what that means. Because at any time, price can come down, find support, and then negate the shoulders, probably do a little back and forth, test the head, a little back and forth maybe, and then break out. So no pattern, candlestick, Western, no indicator guarantees that what you see is going to be the outcome. So always keep that in mind. Everything can change, and it can change in an instant, in an absolute instant. So if we take a look at the chart, and here we'll get this out of the way. I could put this back. So we look at the SPY. We look at the SPY here, and recognizing chart patterns is very important. And this is where train your eyes comes in handy. Learn to recognize the chart patterns. So there's a possible head and shoulders setting up. But wait, why would that be? Because if you look at the chart, you have a gap. That's got to mean something bullish, because that's what we read in so many books. Well, I'm going to defend the books for a minute. I did not mean to beat up on any book whatsoever. In fact, let me defend books right now. Is you can't explain every scenario in print in one book. It's absolutely impossible. First of all, it'd be a lifetime reading it, and it's just impossible. So just because you have a gap up doesn't mean that all the problems in the world are solved. And here we gap up again. It just does not mean all the problems are going to be solved here. We are set up for head and shoulders. Does that mean that we're going to tank tomorrow? No, not at all. Just because we have a partial head and shoulders pattern, partial, it doesn't mean it's going to follow through. But it does, or it is important for us as traders to recognize what patterns could come of what we have here. Not only from this, not only from this, well, that's not what I wanted. There we go. Not only from this far back to today, but also how about what could this chart pattern be making? What did this chart pattern tell us? What is this chart pattern tell us? Think of it as little sections of a paragraph. What are a series of words telling us? A phrase. What is a phrase telling us? So you want to look at the bigger phrase, but you also want to look at the smaller phrases inside there. So what has to happen for this to be a bearish head and shoulders? Well, first of all, it does not have to happen right away. It does not have to come to this top and fail tomorrow. We could pop up a little bit and still fail, and it will still be a head and shoulders. So we just have to recognize those possible chart patterns out there. Campbell's soup. We were talking about this in the room today. Anybody here, by the way, a member of Hit Run Candlesticks or Right Way Options? Anybody here a member? Just say yeah. You don't need to say no. Just yeah if you are. Okay. I guess nobody is. All right. So we were talking about this in the room today. Sharon is. I thought it was the same Sharon. I wasn't sure, but you never know sometimes. But this is setting up as a short. And there was somebody in the room that said, explain this, because I'm seeing higher lows. And that person was absolutely correct. But this may be setting up for a short. This is one that that we're watching here for a possible short. And you just have to recognize the pattern. And I wish patterns were perfect, you know. I wish, let's see here, you know, let's give this a pair of eyeballs and a little nose. There we go. We have a head, and then over here we have a shoulder. And how about a shoulder here? I wish it was perfect like that. I really do. I truly do. Yeah, Trevor, there is a recording, and you'll be notified of where the recording is. I think within 24 hours. I get the recording, and then we post it on the website, and you'll get a link to it. Absolutely. So anyway, we're going to call this a shoulder. We're going to call this a head. We just don't know where this second shoulder is going to actually present itself. In fact, we don't even know if it's for sure going to present itself. Notice the phrase we're looking at. Think about it as a phrase. See that phrase? The person in the trading room was looking at this phrase. Whoops, definitely wrong color. Let's try green. They were looking at this phrase and couldn't understand why this was a short pattern. I completely understand. Let me show you something here. Let's take this like this. Look at that chart pattern right there. You know, you blow it up, and if you look at that phrase, man, look at this. We have a very nice bullish trend. We have a high. We have a failed high. Okay, but what we have is the bulls can't get it through, but the bears can't knock us down. So, and we are still making those higher lows. This is a very, very bullish chart if that's the only phrase you're looking at. Even though we're swing traders and we trade typically overnight to, I'll say, 10, 15 days, I think my actual average is maybe 6 to 8 days in a trade max. And most swing traders are that way as well. That's what I have found anyway. So when I look at that, I do see that very bullish pattern. But when you look at the rest of the chart, I just don't see how that could possibly be bullish. Now, it may be bullish for a few more, for a little bit of a move up, a little bit, but the overall pattern is screaming, look out below. So now what we have to do is we just have to be prepared for that. Now, one of the things we might do for that is we might look at something like the 50-day simple moving average. 50-day simple moving average. One of my very favorite chart patterns of all time for the shorts is what we call a blue ice failure. Now, that was a name given to it by a very, very good trader named Dave Elliott, the late Dave Elliott. You may know him or may have heard of him by First Wave. He's no longer with us, but he's the person that put this together. He's the person that taught me this chart pattern, it's just a terrific chart pattern. So what we're looking at for what we call blue ice failure, and it's just the 50-day simple moving average. And my favorite scenario in this, there's a couple of scenarios that actually could happen, but my favorite scenario is a chart that trends up, breaks down to below the 50, and then finds a sell signal right in this area. That would be a short, and down we go. This is also a bear flag. Once again, you need to know a few chart patterns. That's all you really need to know. This right here is a bear flag. This right here is a hangman. You know, you look at this chart, and that's not a bearish engulf. You're right, it's not. I know it's not. But let's not discredit it. I'm not saying it's a bearish engulf, but don't look at it and say, oh, it's not a bearish engulf, I'm not worried. Believe me, there was a statement made right there. And then we had follow-through. The bulls did take it, and they did travel back up, and you can see exactly right where it paused, and it traveled up higher just to fail big time. Well, this might not be where the money is. The money might be yet to come. We rally up. We may be setting up for another failure, And if we want to go back and look at where it might fail too, what we want to do is look for support. So I see a little support about right here. Oh, maybe in this area here. And, maybe somewhere close to there. We'll go right there, actually. So that might be where the money is on once we finally get ready to check out up here, if we do. You just need to wait for the sell signal. Now, here's another thing. And, I don't know if this has anything to do with bearish charts or not, but it's one of these little trader's tips that is it's just extremely valuable. And it's the trader's tip of you don't have to buy it right away. You can wait until we get an honest to goodness sell signal in there. In fact, for that matter, you can wait till it breaks below about this level right here before you get in it, as long as you see the potential to the downside. What if you waited till about 61.55 to short this? Our first target here, we're 7%. Now, this is Campbell's soup, okay? You're not going to make buckets of money. 7%, I got to be honest, I'm not going to short this for 7%. Now, if you trade options, that might be a little bit different. I personally do not trade options. Right Way Options is a division of Hit and Run Candlesticks, and Doug Campbell runs the Right Way Options. But this is an excellent chart to demonstrate what the chart patterns might look like. That's why I'm using this one right here. So even if you waited till we move down here, you can see there's plenty money to be made. Plenty money. All the way down here is about 15%. I do have a couple, like I say, I picked a couple of charts. Let's look at this one here, and this is actually a chart that Right Way Options was recently in shorting. Well, but let's just take a look at the chart pattern. You see this double top? See that double top? And by the way, double tops don't mean that you're going to have failure. That's not what they mean. Double tops, if they don't break out and you start seeing a little sell signal, it does mean that you're very likely to see a pullback. And there's a difference between a pullback and a failure, a pullback and a correction. There's differences right there. A lot of times if you go to shorten something up here and you don't have really good follow through or a good path, what it turns out to be is just a little pullback, and you really don't make any money on it. You just spin your wheels. And it could be because we're trying to pick tops. In long charts, you may be trying to pick bottoms. Rather than try to pick the top, let the chart prove itself. One thing you might be able to do is allow it to move down, make that blue eyes failure, and then when it rallies up, when it starts breaking down again, that's a pretty good clue. And you can see how this chart, this is picture perfect right in here. So down we go, we bounce up, and then back down, and see how we can't make higher highs. We have a lower high, we bounce up, a lower high, a bounce up, a lower high, bounce up, lower high. So watch for that. I mean, this still looks like it may move further down, but it also, right now, it could be setting up for a little relief rally. Let's see, Trevor's asking, can you talk about the scan? What are you scanning for? Sure. In this particular chart, what I'm scanning for is charts that rally up and pull back to that 50-day simple moving average. Let me show you a scan real quick, which there's not many on it just because a second here, I can't do two things at once. Just because the market is rallied up so much, and it's been rallying for the last couple of days, really. So there's not too many on it, but this is one of my favorite, and then one of these, I can't remember which one on this list is it, so that's why I went to this. One of these here is on our list down there. Oh, there it is right there. Now that I see it, I recognize it. So what it's doing is it's looking for stocks that have failed the 50-day moving average, rallied up, and they're failing it again. Or the scan is also set up so it just simply finds those stocks that it fails about that 50 simple moving average. But here's another thing that it does. I'm going to bring up the 200 simple moving average here. Okay? Because reversion to the mean is something that is just absolutely true. And it's because stocks move in a wave formation. So they move up and down, up and down, up and down. They can move, let's see here, let's get some arrows, green. They can move up, we'll go blue sideways, and then red will go down. So there's only three directions a stock can move, and this is it right here. But then within those directions, it moves in a wave formation, or up and down, up and down, up and down. They all do that. And once a person accepts this right here, man, you're on your way. You've just had a huge aha moment once you accept this fact right there. So what happens is when we start changing the direction of where we've been going, for instance, we've been going up. We've been going up. When that direction changes, what it'll do is it'll move back to where it's been before multiple times. And that's kind of the way a moving average is built. You know, when you think about a moving average, more times than not, they're calculated on the close. So it takes the average over a period of time on the close. Well, that's what the 200 period moving average is set up. It's just set up the same way. So what happens is when we start failing, we fail to these common areas. Now, I'm not saying the 200 is the place it's going to fail to, but what it is, it's the direction it'll fail to. So when I start seeing that failure happen up here, what I want to make sure of is I have enough room to make money. So the scan that I particularly like, this is my favorite short scan here, is notice we have 18%. You can see up in this window in the top left here. I have an 18% possible profit. Now, I'm not saying you're going to make 18%. In fact, rarely does anybody actually make the full 18%. But if you could just get half of that, I would bet you'd be happy. And that's what swing trading is about. Swing trading is not about hitting 30%, balls out of the park. Swing trading is about going to first base, second base, third base, and getting home. It's not about whack the ball and run all the way to home. Now, I don't know about you guys, but I'm old and I'm a little bit chubby. So I just want to hit that ball, and I want it to get to first base so I can rest up, so I can run to second base so I can rest up. But I do want to finish the game at home. That's where that's where the money comes in. So you don't have to claim that whole buy and sell right here. You can just get a piece of that action. All right, let's see. How do you view the chart? How do you view the chart? George, can you ask me that again in a different way maybe? I'm not quite understanding what you're meaning by how do you view the chart. Let's see. How do you get the T-line on the chart? Is that a standard indicator? Absolutely. The T-line is nothing more than the 8 exponential moving average. That's all it is. The 8 exponential moving average. If you have a charting package, and if you cannot get the 8 exponential moving average, I would throw that charting package in the garbage. Is what I would do. All charting packages should have that. There's nothing fancy about the T-line. That T-line is just something that I created long ago. It's one of those indicators that when put with a chart, and if you understand how to use it, what I did is it dug me out of a hole. It made me go from wishing I could trade for a living to actually trading for a living, and that's what the T-line did. So let's see. let's see, George, where is the chart? Okay, you've got it. I see 3 columns of. Oh, okay. You just needed to adjust your window there. I see. Thank you, Dinesh. So you're looking for stocks that were above the 50-day yesterday and is now below the 50. Trevor, you're kind of right. You're kind of right. You're really, really close. What we want are stocks that were above but trending, not just merely above, trending above, pull back and then fail. Like this right here did not fail. This did fail. See how we're below now, and now it looks like it's starting to fail again? See, this is a prime candidate for a short down the road. I mean, this is set up prime. This is today. So this is prime right now. But you still need to see the follow through, so you want to make sure of that. You always want to use a stop up here. Always use a stop. Let's see here. Let's and that was the actual only one that I really liked on that list today. Let's look at FedEx. Look at FedEx. Look how FedEx might be failing here. See how it might be failing? Let's go look at the weekly chart. Wow. Check this out. I mean, look at that. See how we went down, failed, and look at the money that could have been made. Look how we went back up. By the way, this counts. This counts. If you're somebody that uses moving averages, which believe me, I think they're great. I use them all the time. But if you think this has to touch, right exactly, stop thinking that way. Okay, stop thinking that way. If I could make this moving average a 1/4 inch thick, I would, but I can't make it that thick. Because moving averages, just like trend lines, they should be fat crayons, not thin pencils. But you can see how it failed right here. We rallied up, and are we heading for another failure? Are we looking bullish? There's some folks that would look at this and say it's bullish, and I could possibly make a bullish argument on it. But one thing that I can't get away from is this right here. You can't hide from that. You can't hide from that at all. And if we start below the 50-day simple moving average here, and we get down there and we rally back up, and these are relief rallies. It's like this right here. That's a relief rally. Now that's one heck of a good relief rally. Remember, this is a weekly chart, so I mean that's a money-making relief rally for the bull. But all that is a relief rally. So we pop down, we make another relief rally, we could be setting up to move lower. But all you've got to do is recognize this chart pattern. Also, here's another problem, or something I hope to help with, is when we look at these chart patterns, don't focus so much on the right-hand edge. We talk about that a lot in the trading room. Look at this chart overall. Where might it come to? And all you've got to do is just put lines in peaks and valleys. Just start doing that. I talked about this yesterday, and I can't believe the people that sent me an email and said, "Rick, that was just amazing what you did. I made it so easy." But when you're drawing trend lines, and this is something everybody should do, just simply, in fact, when you're looking at the chart, make the chart so you can't see the candlesticks. You don't want to see the candlesticks right now. You don't want to look at price action. Just simply find the peaks and find the valleys. That's all you got to do. And in fact, don't do it that way. Let me take that back. Just find the peaks. Just find the peaks. When you find the peaks, draw a line. So let me get rid of this one. When you find the peaks, just draw a line. When you look back and you look at this chart, then when you see a peak that matches up with a valley, you've got yourself something right there. Or when you've got a peak that matches up with another peak. Look at this. Look at all these peaks. Look how it matches up with these peaks over here. When you have multiple touches, that's what that is, those become excellent targets. So when I look at FedEx, what's our downside potential on this? I'm going to go all the way down here. 38%. So all this chart has to do is start to get bearish, and I'm pretty sure we can pick up some money. And like I said, I think most people here would be happy with 10, 12, 15%. So really all you've got to do is trade this down to 12, 15%. Don't be afraid to take your money, or at least put a protective stop on there. And look at the potential. At any time, this could turn absolutely bullish. And when it does, we go find another one. It's real simple. Let's see. And Trevor, did I answer that well enough for you? Because that was a good question. I want to make sure that you're very comfortable with that. Let's see. How do you use the T-line and other indicator to scan setup trades? So what time frame do you normally look at to scan the stocks, and when you actually trade it? Okay, let's break this question down. First of all, today's about selling or about trading short patterns, not necessarily about the T-line, but we'll certainly put some T-line stuff in here. As far as other indicators, in all honesty, what you see is what you get from me. This is what I use right here. The chart that I show in the trading room most of the day is this one right here. That's the chart I look at mostly. This would be this one and the first one I showed you. They're very, very close to the same, but those are the two main charts that I look at. And there are no indicators other than volume and some moving averages. So as far as stochastics or MACD or this or that or the other thing, I really would like somebody to explain to me in English, not without any fancy jargon that is a load of baloney, but somebody explain in English how trading this chart right here, how an indicator might have helped you make 20% in this today, like we did in the trading room. How could stochastics have really helped you here? How could MACD have really helped you? How could this, that, or the other thing really have helped you? And really, they don't, because we can certainly go scan for, say, stochastics or RSI or MACD, doing something. But at the end of the day, what we're looking at is what is price doing and what is the pattern doing. That's what everyone looks at the end of the day, or at the end of the trade. So if that's the case, then why bog your mind down with all that stuff? Now, as you can tell, I'm not pro-indicator. I'm not against indicators. I'm just not pro-indicators because they generally get in your way. We have a chart that we look at in the trading room, and it's this chart right here, and we call it the naked chart. And there's the naked chart right there. And there's not an indicator in the world that will tell you anything that I can't tell you on this chart. For instance, I can tell you the chart broke out about right here. I can tell you the chart has been trending up. I can tell you that we're going to see resistance about right there. And I'm going to tell you that the chart could likely go to about that area right there. I can tell you that the chart just naturally is going to go up and down, up and down. Not an indicator in the world is going to help you do any of that. And at the end of the day, this is what you're doing anyway. So anyway, I'm sorry. I didn't mean to get on my little soapbox about indicators. I just, I really just don't use any. Now, when scanning, I do use moving averages as indicators because they are averages of where the chart has been. And that is what I'm looking for. I'm looking for those averages. If we go to this scan right here, which really there's only one here that looks really good right now. Just I gotta find it right there. There's only one, and it's that GG. So I'm going to turn that chart over. Yeah, and really I just looked at charts that sold off today a little bit. So what I'm going to do now is I'm going to go to this chart with all the moving averages on it. So you can see what I might be looking for. You see how we've been down, we've rallied up, and now we're back. So I'm using the moving average in the scan to help me find that. In this particular scan, I'm also using the 20-day simple moving average. The T-line is not involved, although on this particular chart, I have the T-line up there. Yeah, it's not very difficult at all. How many people here have TC2000? Raise your hand, please. Does anybody here use TC2000? All right. If you use TC2000, here's the code that I use right here. If you don't use TC2000, copy this down anyway, because somebody that uses Thinkorswim or TradeStation, they could probably recode that for you. We have people in our members that would be more than happy to do it. I just don't have any of the other codes right now. I'm a TC2000 user, and that's the code that that I would look at. That's my go-to right there. Metastock. Actually, Derek, I'm working on some projects with Metastock right now. So a lot of this stuff will be available soon in Metastock. It's just not available now at this moment, and I don't have any of the Metastock coding for it. But I am working on some projects with Metastock. In fact, I think I'm scheduled as a speaker. I don't know the particulars, so can't say anything more than that. But sometime in September with Metastock. Okay, let's see here. Can you explain the logic that we can use? Oh, okay, yeah, I can do that. Absolutely. ABS just stands for absolute, and then the C stands for close. So I want the close minus the simple moving average 200 divided by the close. Wait a minute. I just lied to you a little bit. Let's see. I want the close. Absolute, I want the close minus the 200-day moving average to be greater than 10% greater than the close today. That's what I want. That's what I'm looking for. And the close greater than the 200 moving average, and the close less than the 50-day moving average. That 0.10, that's one of the big tricks right there. What I'm doing is I'm putting 10% between here and the 200 period moving average. That's one of the big tricks. So let's go back to indicators for a moment. I do not use indicators, but I do use indicator logic. So if you were to use, say, stochastics, and if you were to ask yourself, is price overbought, oversold compared to the 200-day moving average? Now, see, I do use that kind of logic. I just don't use the actual, say, stochastics lines. But I do look at being overbought, because when we're too far away from a major moving average, what happens to a price? It tends to come back to it. Common sense. Let's just use some common sense right there. And you go look at any chart you want, and I urge you to look at hundreds of stocks. Just look for that one little thing right there. That one tiny little thing. Look how stocks always float back to their major moving averages. The 50, the 200, the 20 simple. Top 3 moving averages in the world. Right there. Just watch those. There we go. Okay, so let's see. I did that. What do we have here? We don't need this anymore. Yeah. All right, let's look at a couple of more here. Disney. Let's take a look at Disney. Let's go way back and look at Disney. Look how we were up. Look how we failed. You see how it popped back up? Now that didn't come anywhere near the 200, so or the 50. So there's really no way this scan would have picked this up at all. No way at all. But let's move ourselves to this area right here. There you go. Now you should be able to see it. Look how we popped down, and now look at that. Look at that bearish candle pattern right there at the 50. That would have been a slam dunk. Sell it. Short it right there. You're going to put your stop right here. You're going to put your stop here. So if you shorted, let me move this over just a little bit like this. And let's make this a little bigger. There you go. So if you shorted on this day, just anywhere in that day, and you put your stop up here, say you shorted at the very worst, I mean right here at the low. If you shorted there and it came back up and stopped you out, you'd be out what, 2.5% maybe? Look, I don't mean to upset anybody, but if you can't afford a 2.5% stop or can't afford to lose 2.5% in stock trading is probably not the game for you. So 2.5% is nothing, absolutely nothing. Look how this thing just continued down. Look what you could have made on this all the way down. At some point, you would have sold it, 20%, 15%, somewhere in there. You can see also the T-line. You guys asked about the T-line. See when it pops up here, how it fails the T-line? That's one way I use the T-line. There's a lot of traders, and usually this is something that new traders or struggling traders do. What happens is they come over here and they see this candle here, a little bit of a wick, and they start seeing this and they get all kinds of bullish. They see that, they get all kinds of bullish. Because one, they're trying to pick bottoms. That's a big no-no. That's a big no. If you do that, stop that. Just stop it. Just stop trying to pick bottoms. To make it worse, they see this bottom right here and they see a little bit of support. Oh my gosh. Whew, we have a wick, we have support. This has got to be a bottom. It's Disney. How can you go wrong? This could be, doesn't matter the stock. Without a pattern after this breakdown, without a bullish pattern, you can't be going long. And this is what gets so many people in trouble, and now they don't know what to do. This is where I get the phone calls right here. Rick, I went long this because of this, and what am I going to do with this thing? How am I going to basically, in many cases, here's how the story goes a lot of ways. I can't tell my wife that I did this. Can you help me here? And that's a true story, okay? I'm not exaggerating that. So always make sure that the pattern develops and never try to pick a bottom in a chart. So anyway, here we are back. We're still looking at Disney. So let's take a look at Disney. What's it doing right now? We're putting in what could be a blue ice failure right here. What else do we see in Disney? What other chart patterns can we find? Let's go to this here. Could we be seeing a head and shoulders? We could be. Yes, we could. How about another chart pattern that we haven't talked about at all? And I want to come over here to a clean chart and show you this one. Right there is good. And this chart pattern is the head and shoulders, the rounded top breakdown, the blue ice failure, and this chart pattern. These are my favorites around that 50-day simple moving average. I really, really like this. And this is the other one. And this is the dreaded H pattern. And if you're familiar with the J hook, the ABC breakout pattern, the 1, 2, 3 pattern, this is the exact same thing, just upside down. All it is. And here's your H. Right there. That's all it is. It's a low with a high and a failed low. if you're bullish, and this is where most people understand it, when you rally up, you pull back to a higher low, this being the low, so this being the higher low, and then we rally up and break out of that high. This is the same chart pattern, just the other way. It's just simply a high to a low to a lower high, now to a lower low. And that's just what has happened right here. So if we come back over here, where are we? There we are. You can now see how this is starting to fail and could be setting up for that short. Let's take a look at this on a weekly chart and see what it looks like. Look at that weekly chart. Look at those blue ice failures on the weekly chart. Look at that. Look at that. What are we doing? Trend line. What are we doing? In the bigger picture, we're making lower highs. Now, can we trade this bullishly? Absolutely. Absolutely we can do that. Why not trade the little bullish runs? Nothing wrong with that. Little bullish run. Look at that bullish run. This bullish run. This bullish run. You just have to understand and realize that what you're really doing is you're trading a bullish relief rally. I want to say that again. A bullish relief rally. Here's what I find. A lot of people, when I say that, all they hear is rally. That's all. The word relief, it just somehow didn't make it. It got lost in the twilight zone. Please, the key word here is relief. Too far down, you have to let off a little pressure. So you have a little relief rally. Too far up, you've got to let off a little pressure. So you have a little pullback. This has to happen. It has to. There's no getting away from this. You cannot hide from this fact. So there's nothing wrong with trading, swing trading these little rallies. Just understand they're nothing more than relief rallies in a bigger picture. And if you look at the bigger picture, here's the weekly chart. Look at Disney. That does not look bullish to me, but we can trade some bullish charts. But let's look at the bearish side. Where are our targets? Look, we don't have time today to talk about these right here. I'll tell you what those are. They're all three the 200 period moving average. They're just set up differently is all they are. One is set up 200 SMA on the high, one is the 200 simple, and one is the 200 simple, but it's weight forward. Like I say, we don't have time to get into that too much. But when we start traveling down like this, those always become directional targets. So this is the next directional target. Now from there, you fine-tune it with price action. But look at Disney. We stand a chance of a 6.5% trade. Now that does not excite me. I got to tell you, that does not excite me. What excites me is the potential of maybe the 15% trade. That's what excites me. At Goldman Sachs. Take a look at Goldman Sachs. Look at that weekly chart in Goldman Sachs. Let's go back to a little bit of pattern recognition. You've got to instantly be able to see these. Once you can see these in the past, then what happens is you start to recognize them for the future. So as an example, let's see, can I do this? Am I clever enough to figure this out? Let's see here. I want to go, what do I do? Oh, hey, check it out. I'm a little technology challenged sometimes, so I'm kind of proud of myself for that one. Okay. All right, we already know what the chart's going to be. We already know that, which is good for education. So look at this chart here. Here we have a scenario where we're up, we're higher, shoulder, head, we've moved back, and now we're maybe in for a bullish move. Why not? Why can't this be a bullish move? Look at that hammer. Look at that support. Man, let's get all bullish on that. Well, wait a minute now. Hold on here. I'm not against getting bullish, but what kind of bullish are we going to be? So let's look at what we have. We've got that, whoops, wrong one. We've got this shoulder up here, and we've got this head up here. What could happen? So it's okay to be bullish. Just be prepared of what might happen right here. So let's move forward. Forward. There we go. All right. Let's get all bullish. We did a good job. What happened right here? What happened right there? You see, you've got to be able to quickly get out of that. Oh, come on, Rick. There we go. You see what's happening? So by recognizing what could happen, you've got a left shoulder, a head. What could happen? Once you visually can see the chart pattern, then you can start visually seeing what could happen. And I do the same thing with bullish charts as well. So here we are. There we are on Disney. Goldman Sachs. So you can see how Goldman Sachs was all bearish here. Let's look at it. Let's look at it from a bigger view. What about this chart looks bullish to you? Nothing to me. Absolutely nothing. Now, could we have some bullish relief rallies? Absolutely. What chart pattern do we see staring us in the face right now? How about that bearish H pattern? How about that bearish H pattern? Now, here's something about a bearish H pattern. To actually be called the bearish H pattern follow through, you've got to have follow through. Just like a bullish J hook is not a J hook until it actually breaks out. Then it becomes the J hook. This is not a bearish H pattern until it actually breaks down. But it doesn't change the fact we see what's being made here. You know, if it's cold like an ice cream, if it smells like an ice cream, if it tastes like an ice cream, wait, it's an ice cream. I mean, it is. So if it looks like that H pattern, if it tastes like, smells like, well, it is. So, we can certainly expect some bullish relief rally, but let's be looking at the big picture here. So if we were to break down here, where would we look next? How about the breakout of this bullish W pattern right there? Pattern recognition. You only need to know, 10, 11, 12 patterns. And really, they're not hard. How tough is it to recognize a W? How tough is it to recognize an H? It's pretty simple. Let's see, Trevor, do you start your analysis with the week chart, go to smaller time frame? Nope, I start with a daily time frame. Almost everything I do is on the daily. Now, I will look at intraday charts. Here recently, I've been looking at them a lot. I'm very favorable to the 30-minute chart, 4-hour, 2-hour, and 15-minute chart. Pretty much, let me rephrase that a little bit. I'm pretty favorable to a 30-minute chart, a 2-hour chart, a 4-hour chart, and 15-minute chart, in that order. Nope, I don't pay much attention to anything smaller than a 15-minute chart. There's no value in my trading for it, none whatsoever. Hey, look, before you guys start running off, I want to let me share something with you, because we're at that time now. I'm gonna turn the recorder off here, just so the recorder. There's no reason for the recorder to be that long, but what I would like to share with you is I would like to offer you something, and you're going to receive an email with the same thing. But if you're interested in options, or if you're interested in a 30-day trial with both right way options and hit and run candlesticks, then if you'll just click on that link, it's $14 is all it is. Pretty fair. Any members in the room, I'm sorry, can't use it. But if you're a non-member, then please feel free to if you're interested. We'd sure like you to do that. Okay, I'm going to turn the recorder off, and I'm going to stay here just a few minutes for anyone that has any questions.